The Fed beginning a two-day meeting. Our senior economics reporter, Steve Leisman, joins us right now with the results of the CNBC Fed Survey. Good morning, Steve.
Morning, Becky. Respondents to the CNBC Fed Survey boosted their outlook for recession this year, lowered their growth forecast, and grew more worried about inflation, changes that appear linked largely to administration policy and uncertainty. 100% of the 32 respondents see no change in the Fed funds rate at this meeting, but 77% see two cuts or more this year, while 19% see no cuts. That's part of the disagreement over how the Fed will react to tariffs. And the recession probability rose to 36%. That's from 23%, now at the highest level since September, but not at the elevated levels that prevailed after the pandemic for most of 22 and 23. The recession probability had hit a new multi-year low in January following the inauguration of the president. That suggests that, like other surveys, the enthusiasm that greeted the president's election has turned more cautious for now. Barry Knapp of Ironside Macroeconomics writes in, "We've had an abundance of discussion with investors who are increasingly concerned the Trump agenda has gone off the rails due to trade policy. Consequently, the economic risks of something more insidious than a soft patch are growing." The markdown in GDP to 1.7% is the first decline in the outlook since September. The series had hit a high again in the wake of the election of the president. Growth is forecast to bounce back to 2.1% next year. There was also a decent jump in the inflation outlook. CPI now forecast to rise to 3% by year end before dropping back down to 2.7% in 2026. Now, despite lower growth and higher inflation, the outlook for the Fed shows two rate cuts built in this year with just a single 25 basis point cut in 2026. The Fed will remain over the next 2 years above that 3.4% neutral long run or terminal rate, call it what you will. Now, part of the reason respondents think the Fed can still cut, 2/3 believe tariffs will pass through the economy as one-time price hikes rather than sparking broader inflation. Still, part of the disagreement in the survey, 38% worry that tariffs could spark a lasting bout of inflation. So, Becky, we've been at this plus 50% rate for the probability of recession in 23 and 24. It did not result in a recession, or it did not correctly predict one. Now we're at 36, which is elevated from the 23 that was the low in the wake of the election.
You know, we had Roger Ferguson on yesterday, the former vice chairman of the Fed. And, Steve, what he said is that he thinks that rate cuts are further away and longer off than most other people think. I think he'd be in that 17 or 20%, whatever it was in your survey, of no cuts or maybe one cut to be anticipating that. What was that, 23%, I guess, and 77% thought it would be two cuts or more?
19% see no cuts, yeah.
But maybe is it 23% that see one cut or no cuts? I'm just trying to do the math because 77 was two or more.
Right, 77 is two or more, 19% was none, and then there was, I guess there was a small percentage at one. But I'm kind of in Roger's camp a little bit, not entirely. Yeah. I think the market may be too aggressive in the Fed, in how it's timing of the Fed rate cuts, because I think that the Fed is going to need to see the impact of these tariffs on the CPI. It has to become comfortable that this notion that they're one-time price hikes is all there is. And then you're going to need, I think, pretty strong evidence that there's some kind of weakening in either the job market or in the growth trajectory to prompt those cuts. Remember, the Fed's default here, I think, remains to cut. It still thinks it's restrictive, so that means that there's a bias to come down from the forecast, but you need these tariffs to pass through, see what the process is, see what the impact is. And I've talked about this, Becky, this idea that I think what you do is you look at prices of goods that were tariffed, and then you look to see if it's spread out to non-tariff goods. Does this end up being a green light for businesses to raise prices because other prices are going up? Also interesting to see how U.S. domestic manufacturers respond to tariffs on foreigners. Do they raise the price to the tariff level and stop there?